Imagine retiring with $1 million portfolio invested entirely in dividend ETFs. Your plan seems simple. Collect quarterly distributions. Reinvest what you don't need. Allow compounding to continue working. Enjoy a growing passive income stream. But what happens when a recession arrives? Markets fall 20%, 30%, sometimes even 50%. Financial headlines become overwhelmingly negative. Companies slow hiring. Consumers reduce spending. Corporate earnings contract. And suddenly, the question every retiree fears becomes unavoidable. Can dividend ETFs continue funding retirement when the economy enters a downturn? The answer is neither a simple yes nor a simple no. Because the success of a dividend retirement strategy depends less on yield and more on dividend quality, free cash flow strength, portfolio construction, and investor expectations. Today, we're going to examine the reality behind retiring on dividend ETFs during recessions and determine whether this strategy can truly survive economic stress. Welcome to a deep dive into SCHD, the Schwab US Dividend Equity ETF. This investment vehicle attracts attention from investors seeking reliable income. SCHD offers an impressive dividend yield around 3.4% and a remarkable 5-year dividend growth rate, often exceeding 12%. Its low expense ratio of just 0.06% makes it a cost-effective choice for long-term strategies. What truly sets SCHD apart is its rigorous screening process. It doesn't simply chase the highest yields. Instead, SCHD targets companies demonstrating exceptional business quality. This includes profitable enterprises with healthy balance sheets and robust free cash flow generation. The ETF prioritizes firms with consistent dividend growth, ensuring sustainability. This stringent approach means SCHD selects companies resilient even during economic downturns. These businesses have durable competitive advantages, strong cash flow, and conservative payout policies. Such companies are better positioned to maintain dividend payments when times get tough, offering stability to your portfolio. During recessions, business quality becomes acutely clear. While many companies struggle, SCHD's holdings are designed to weather the storm. For retirees especially, SCHD offers an attractive dual benefit: a substantial current income stream combined with significant future income growth through compounding. It strikes a crucial balance. Investing in SCHD means investing in high-quality, dividend-growing U.S. companies. It's a strategic choice for consistent income and long-term wealth accumulation. Now let's compare 3 additional leaders in the dividend ETF universe. First, VIG. Ticker, VIG. Dividend yield approximately 1.7%. 5-year dividend growth rate around 10%. VIG focuses on companies with at least a decade of dividend increases, emphasizing dividend aristocrat-style discipline and long-term consistency. Next is DGRO. Ticker, DGRO. Dividend yield approximately 2.1%. 5-year dividend growth rate roughly 7%. DGRO requires dividend growth and payout sustainability, including screens designed to avoid excessive payout ratios. Finally, VYM. Ticker, VYM. Dividend yield approximately 2.3%. 5-year dividend growth rate, roughly 4% to 6%. VYM emphasizes higher-yielding companies and broad diversification across more than 500 holdings. Notice the pattern. Higher yield frequently comes with slower dividend growth. Lower yield often accompanies stronger long-term compounding. This trade-off sits at the center of retirement planning. Retirees need income today, but they also need income growth that can outpace inflation over decades. Let's stress test a hypothetical retirement scenario. Assume an investor has accumulated $1 million. The portfolio is allocated equally among SCHD, VIG, DGRO, and VYM. The blended starting yield is approximately 2.4%. That generates roughly $24,000 annually before taxes. Many investors immediately identify a problem. $24,000 may not support a comfortable retirement lifestyle. This reveals one of the biggest misconceptions in dividend investing. A portfolio size that looks impressive may not produce sufficient income. However, dividend growth changes the equation. If distributions grow at an average annual rate of 7%, income approximately doubles every 10 years. This is the power of compounding. Yield on cost becomes increasingly important. A portfolio that starts with a modest yield may eventually generate a much larger income stream, relative to the original investment. The challenge is surviving the early years without over-withdrawing capital. A recession offers the real test for investors. As portfolio values decline by 20, 30, even 50%, the overwhelming pessimistic media narratives become louder, and market stress indicators reach extreme levels. In these challenging times, income-focused investments like dividend stocks can provide a degree of stability, not typically found when markets are in decline. The core question becomes, are the underlying businesses still producing free cash flow? Companies like Dividend Kings and Aristocrats, with their long history of consistent dividend payments, are often resilient due to their healthy free cash flow generation. This focus on the health of the underlying business, rather than just stock price fluctuations, is crucial. For retirees especially, the stability of an income stream that continues to pay out, even when the market is down 30%, is invaluable. However, it's important to remember that distributions from ETFs are not guaranteed and can fluctuate. The goal is to maintain income stability to prevent forced asset sales at depressed prices, a critical component of successful retirement planning. This brings us to the most important section, the danger zone. Many investors chase yield. A 6% yield appears more attractive than a 3% yield. But yield alone can be deceptive. Extremely high yields often signal elevated risk. A declining business can temporarily display an attractive dividend yield because its stock price has collapsed. This is the classic dividend trap. Another risk involves valuation. Even great dividend ETFs can produce disappointing returns if purchased at excessive valuations. Investors must also consider sequence of returns risk. Retiring immediately before a severe recession can significantly impact portfolio longevity. This is why many sophisticated investors maintain a cash reserve alongside their dividend portfolio. The reserve acts as a buffer during market stress. It reduces the need to liquidate investments during unfavorable conditions. Retirement success depends on risk management as much as investment selection. So can you really retire on dividend ETFs during a recession? Yes, but only under specific conditions. You need a sufficiently large portfolio. You need realistic income expectations. You need exposure to quality businesses with durable moats and strong free cash flow generation. And perhaps most importantly, you need the discipline to remain invested during periods of market stress. Dividend ETFs are not magical income machines. They are tools. When combined with sound portfolio management, Dividend Aristocrats, Dividend Kings, and Dividend Growth ETFs can create a remarkably resilient passive income stream. The question is not whether a recession will occur. The question is whether your portfolio is built to withstand one. Let us know in the comments. Would you trust SCHD, VIG, DGRO, and VYM as the foundation of your retirement income strategy? This video is for educational and informational purposes only and should not be considered investment advice. Always conduct your own due diligence and consult a qualified financial professional before making investment decisions.